but I want to give you an actual spreadsheet that I use to give me a really good working capital amount. Before I show you what that is, I want to make sure that you understand typically who keeps the AR and who pays for the AP. This is where a lot of confusion happens. Sometimes sellers think of the cash in their account and the AR, the account receivable, as theirs. They did the work for it. But just like a piece of equipment that's needed for the operations, the working capital is technically an asset of the business and should be, in some cases, depending on the size, included in the transaction. So the seller keeps pre closing AR, money owed for the work they did. Seller pays for pre closing AP, bills that they racked up before closing, but the buyer gets post closing AR and post closing AP, less some sort of a working capital adjustment there. That way, everyone handles their own work, but you make sure that you're walking into something that you're not going into just writing a check. Think about this. If you buy a business, you have to essentially write two checks, one for the purchase price and then two to fund the working capital. So that either comes from the seller leaving in some working capital, which includes some cash or some AR that they haven't yet collected, or it comes from the lender who's going to give you a line of credit for the working capital.